Now we're going to look at emerging markets, Europe, but we want to start with what's happening in the emerging market land. Because when you look at the EM side, one of the things that we've been talking about very aggressively is that they're going to cut spending. And we've seen that with rates going up, with just liquidity coming out, and primary spending cuts in 2022, according to draft budgets or fiscal plans in a percentage. And emerging markets will cut spending by a lot. And I think this is an important piece, especially when you start looking at India, Indonesia, other ASEAN nations, because this is that pressure that we keep talking about on the global market. And this is that fiscal drag that we've been alluding to, where some of that spending is pulled forward, and you don't see the same type of benefits that are propagated throughout this period, and even cutting below pre-COVID levels. Because if you think about what happened during 2020, 2021, you had excessive spending, you had excessive debt. So now you have to cut further than what you normally would have, which again is why we call it that fiscal drag, which is where you'll see that drag on economic growth and these pressure points, which again is going to lead to the problems as we head into 2022. Then when you look at private consumption, very weak, you're just not seeing this recovery in terms of just underlying private consumption. The pressure is there in Vietnam, and this is a specific chart to Vietnam. You're just not seeing them spend, and you're just seeing it fall well below what is normal because people are concerned. Things are getting better. You're seeing a reopening, but inflation is ramping up exponentially in a lot of these countries. There's concern about local currencies, which is here when you look at the CITI Emerging Market Inflation Surprise Index. Inflation continues to surprise higher. There's a lot of this fear that is around wage growth, what economic structures will look like, which again is keeping people on the sidelines, reducing underlying private consumption. And it's playing out in other places, not just in Vietnam and some of these other areas. Non-resident portfolio flows are reflecting that, where you're not seeing a significant amount of emerging market money being deployed, as it's very well, I think, telegraphed that you're going to see these slowdowns, you're going to see these pressure points. And until people understand, or at least investors see the impacts, they're not willing to deploy fresh capital until they can understand and handicap what those impacts are going to be. Then when you look at the emerging market earnings upgrade cycle is slowing, and you're seeing downgrades, you're seeing pressures, because a lot of these companies have already now come out of their COVID slump, their lockdowns. Nobody's going back into those lockdowns. You might get some restrictions here or there, but not a countrywide lockdown. So there's not much less left, and you have more and more pressure. Pricing, wages, exports, again, all of these things are leading to some of that global slowdown, especially in the emerging markets. And then when you look at Turkey as the key example, you look at the implosion of the lira, which is again turning over to the Turkey CPI, continuing to gap up. And then if you look at what is the unofficial side, we're already over 40%. And again, you're seeing PPI is also reflecting that, in just terms of pressure, where PPI gives way to CPI. You're seeing that again carry through, where PPI, or producer price index, is at a record in Turkey, which just means that it's going to pull a lot of these up as companies try to pass through these additional costs as much as possible. But the Eurozone is just as bad. And here's looking at the Eurozone PPI year over year, exploding to new highs. And again, coming full circle to what we discussed in segment one, that is a key component when you look at Russia. If Russia turns off natural gas, what does that do to the input costs? What does that do to the consumer? And you see the pressure continuing to move higher. and material shortages that limit production continue. Percentage of respondents citing a shortage of material and or equipment as a limit to production in EU industries is close to 50% and going higher. So again, this you're just seeing this get worse and worse as these shortfalls continue, and that again is going to drive up prices, going to drive up PPI, going to drive up CPI, going to make them more reliant on the international market, which Russia is still, as we said in segment 1, a part of by about 15%. Now, when you start looking at Eurozone retail sales, things have flatlined a bit, still above trend, but this isn't adjusted to inflation the same way. If we adjust it to inflation, you're still just right around those kind of steady levels. Now, when we look at German manufacturing, starting to tick back up as we discussed, because again, trucks are moving again. You're starting to see trucks are back, above some of these slowdowns. You're starting to see some of that mobility, which will pull that industrial output higher. Now, there's a lot of backlog, so it's not going to be a perfect match of one-to-one, but it just shows that things are going to continue to get better. Not pre-COVID better, but again, still closing some of that gap. Now, on the other side, the assessment of the business situation in the German automotive industry, depending on where you are, the situation in the German area's industry is getting worse. The situation, the IFO indicator slid to 9.6 points in November, down from 17.4 points in October. The downward trend is primarily due to the situation for suppliers. Automotive suppliers gave much bleaker assessments of their current situation than manufacturers. Which again, the index for suppliers fell to minus 23. So you're seeing suppliers again getting worse again, and that's going to pass through. So we saw some car manufacturing, automotives getting a bit better. This is a leading indicator that it's going to be a drag again, and that's why we saw a nice pop in the manufacturing side on the PMIs. We see that softening as we go into Q1 of 2022. And the construction PMI not getting better. We talked about it. Nice little bounce, but still contracting, still negative, and we don't see it getting much better. And by better, it means we see it improving slightly, but not getting back into expansion, still being in a contractionary standpoint. And the German manufacturing orders, this is why we're saying this, you're seeing them come down again. Manufacturing orders are falling, which again is indicative and a leading indicator for where things are going. And where are they falling? They're falling in non-domestic, and so domestic has gotten a bit better, but non-domestic is falling, bringing the total down, because remember, Germany is an exporting country. So as the new orders come down from the export perspective, this just shows where that additional pressure is going to be on their underlying economy, which is where you start looking at German expectations of economic growth starting to flatline. But the whole Eurozone inflation surprise index, again, inflation keeps massively surprising to the upside, putting more and more pressure on where people think things are going to go, and it's not being factored in. Which is why it keeps blowing through estimates, because you keep seeing these surprises to the upside, keeping the pressure points, keeping the underlying negative views in the market, which again are some of those key components that we've continued to talk about and highlight, which is when you start looking at France, service PMI was expected at 58.2, came in at 57.4. And then you look at composite, as we said, 56.3, it came in at 56.1. So things are getting a little bit slower as inflation's getting worse, which again is putting these pressure points in the European market, especially on Germany, which is going to get hit by, again, emerging markets, because Germany imports raw materials, imports semi-finished goods, a lot of that coming from EMs, and those are coming down. You're seeing that reverberate through the system, keeping that global growth fairly capped, which is why we remain concerned. U.S., again, a bright spot, but this is where some of the things that people aren't talking about are really starting to show up, which is why we remain very concerned on the emerging market world and what the recovery really looks like. Again, it'll be growth in Europe, driven more by France and Italy as Germany kind of bumps along the bottom, but Russia is going to be a problem in that. And that's where we see some of this conflict, which we've been alluding to. and I should say directly saying. So again, those are some of the things that we're seeing here. But now we want to turn over and look at Asia in a bit more direct manner, especially in terms of a potential impact with where the U.S. and Taiwan sit, and why I think the U.S. would always defend Taiwan versus letting it fall into Chinese hands.